The US debt limit saga seems over now. President Biden signed into law a bill that suspends the US debt ceiling. In addition, there were hints last week that the Federal Reserve might pause hiking rates. And let's find out how traders' sentiment has changed. By the very end of trading on Friday, the U.S. Department of Labor delivers its closely watched monthly jobs report. It revealed that non-farm payrolls grew by 339,000, which indicated the overheated jobs market. Taking into account that the FOMC makes its decision based on the state of the labor market, it becomes clear why many now expect a 25 basis point rate hike at the next meeting. The greenback managed to partly recoup losses on a Friday, and the ECB also keeps fighting high inflation today. Christine Lagarde will deliver a speech. However, her remarks will hardly differ from those made on Thursday. The ECB president stressed that inflation remained at a high rate and underlined the importance of a further tightening. This means there will be more rate hikes to come. However, the euro is still weaker against the greenback, which appears to be in strong demand. The pound feels more confident against the greenback because the Bank of England will continue hiking rates. Indeed, inflation in the UK is currently at a rate of 8.7%, the highest among developed countries. Last week, GBP USD retraced up from its two-month low, but then incurred losses on expectations of a possible rate increase by the US Federal Reserve. The solid US jobs report prompted speculation that the Federal Reserve would hike rates again. Consequently, the Japanese yen returned to the level of 140 against the dollar, and the Bank of Japan's stance on a monetary policy differs from the Federal Reserve's. The Japanese regulator sticks to its ultra-loose monetary policy despite market pressure and persistent inflation. The Bank of Japan said it would watch exchange rates move carefully and take action if necessary, hinting at a possible forex interventions to boost the weak yen. Perhaps this will help the currency to recover in the near term. Speculation that there would be no pause in the Federal Reserve rate hikes triggered a fall in the value of gold. Ahead of the US jobs report, 75% of market participants anticipated the US Central Bank to pause tightening, and gold advanced to $1,980 at 3 ounce on those expectations. However, already after the release, the possibility of a pause in rate hikes dropped to 66%. At the same time, gold quotes on the way to the key level of $2,000 per 3 ounce unexpectedly reversed and tumbled below the mark of $1,950 per 3 ounce. Meanwhile, sentiment in the oil market, dependent on expectations of the US debt limit deal and the outcome of the OPEC Plus meeting, where another production cut was anticipated. At the same time, the market is filled with a fear that demand will also decline, especially in the light of the latest economic data in China, where the pace of a recovery is very modest. You have watched combined review on the currency and commodity markets on the InstaForex TV channel. We wish you profitable trading and see you soon!